let's jump into this. So thank you, everyone, for joining us today on Monday, where Dan Corliss, Alistair Kemp, and myself, we're going to spend probably the next 30 minutes or so jumping into and exploring the concept of employee ownership trust, with really the goal here is to give you some color, some backgrounds to help you appreciate, understand this as a succession or exit planning option in perhaps the succession plans that you're putting together now for yourselves and for your businesses. Now, just to jump into it then, I want to ask the question really of why EOTs? Why now? Why are we talking about EOTs today? Why are they gaining in so much popularity? We're inundated by questions almost week by week at the moment from our client base around what are EOTs? Is this something for me? There's two observations here really I think are important for us to appreciate. Now, number one, EOTs are not new. Right, so EOTs have been around since they came into legal form in around 2014, and since then the early guinea pigs have been proven out. Right, so we've seen really successful EOT examples of people exiting businesses, getting their money out, employees being incentivized and enjoying life after EOT, EOT businesses selling again afterwards. So there's been a lot learned around EOT transactions. The advisor base has grown massively, and advisors have certainly got a lot better at using EOT structures in lots of different scenarios now. So when you're thinking about EOT transactions, you shouldn't think about it as something new or scary. There's a lot of data and case studies now available, which make this a fairly robust way to exit, and there's data out there now showing this sharp increase of nearly 2,000 exits last year to EOTs. So it's nothing new, it's nothing to be worried or skeptical about. The second observation, which has probably driven a lot of people to join today, is the concept that over the last 2 months, we've seen the Labour government introduce rules which are increasing the capital gains tax rate, which are removing access to things like business asset disposal relief, so the 10% rate that business owners get to enjoy on some of their exit. And with those tax rates effectively increasing, the allure of the 0% tax rate that an EOT can offer, if you qualify for it, is even greater. And certainly there's more companies now where it makes more sense for them to go an EOT route rather than a traditional trade sale MBO route, because the tax calculations works out that way. Okay. Now, with that in mind, I just want to explore briefly the basic building blocks of what an EOT is, so that we've all got a common language and a common understanding of these sorts of transactions, okay, which are not quite as complicated as they might seem. So the parties involved in EOT, you've got shareholders of a limited company, and it must be a limited company. If you're a sole trader or partnership, usually you'd be looking to incorporate that before you'd go down this route. Then you've got a trust, and a trust will have a set of trustees, which can be a set of people, set of human beings, or could be, and quite commonly now is often a corporate entity with a set of directors above it, okay, who control the trust, execute the trust. And a trust must have a set of beneficiaries. And in particular for EOTs, these beneficiaries are the employees of the company. And it's all of the employees, and all of the employees in equal measure. So the concept of equality runs through a lot of the EOT rules, right? So all employees are treated the same and have access to the same value generally across an EOT, okay? So these two sets of parties, the trust and the shareholders, enter into a transaction where the shareholders will sell some shares to the trustees. And the shares they sell must equate to at least 51% of the control, both in votes and economics, of the business. So the EOT must control the company after this transaction. Okay. The trustees then pay the shareholder cash, and that cash is usually paid, normally paid over time, and commonly we see periods of 3 to 5 years to pay out the shareholders, but it can be longer, it can be shorter. Right. And that cash is funded by contributions often made by the company to the trust over that same period. So the cash flows of the company are funding the payments through to the shareholders. Right? And that is a basic EOT transaction. I say basic because advisors are very good at using these rules and using different funding sources to try and make them work for as many people as possible. So, for example, we see more and more that banks can get involved and they can lend money to the company or in some circumstances to the trust to help fund the transaction, to accelerate funds going to the shareholders. Okay, so there's always variations on this, but the basic rules and the basic structure is set out like this. Okay, and like many things in tax and law, what have you, there's always some hurdles and basic requirements that you need to meet in order to be able to access all the good stuff that comes with EOTs. And amongst all those rules, there's normally a few that we find are the most commonly asked, or at least the most important in early conversations. So first of all, EOTs only work if you are a trading company. Right. And so by trading company, I mean, it probably doesn't apply to property holding companies, buy-to-let businesses, asset holding vehicles. This is not going to be a structure that is likely to work for you. Okay, so trading businesses that have customers and general income and qualify under the normal trading rules under tax rules. So you're a trading company, and your trading company that normally in practice has 5 or more employees, and these employees are not already shareholders of the business. And the reason for this is that there are rules within the EOT guidance or rule book, which excludes smaller businesses, perhaps with 2 to 3 employees. Maybe they're in the same family, maybe it's a couple of families running a business, but it excludes businesses where the employees generally already connected to, or they already have ownership in the business. Okay, so EOTs are really designed for businesses where you've got a small or very, very large group of employees that are not already shareholders in the business. Okay, and the last point, which was driving home in our structure here, is that this must be a sale of a majority holding. Unequivocally, you can't do a 10% sale to an EOT and get access to the same tax rules. 25% doesn't work. It must be 51% or more to the EOT. And more commonly, certainly in the transaction space that we look at, most of these transactions are actually 100% sales to the EOT. Now, along with the tax rules, of which there are more nuanced rules that you need to test by as well, there are the initial practical considerations. And really, the top of the pack here is that you must appreciate that an EOT transaction is generally a phased exit from a business. Succession planning still needs to happen. It can happen after the transaction happens, as Dan and Alistair will explain, but it's not particularly common where a owner will be able to enter into an EOT transaction day 1 and day 2 they take off to the beach. Okay, it's very rare that EOTs are used in that way. And linked very closely to that is the concept that you'll be paid out from the cash flows of the business, which will mean there won't be 100% consideration paid on day 1. Okay, so commonly 3 to 5 years, but certainly 5 to up to 10 years has been seen and is possible. Okay, but 3 to 5 years is normally the target area, certainly where valuations are set and where modelling kind of tests whether an EOT works for you or not. And lastly, and to some extent, most importantly, is that there's got to be at some level a buy-in to securing a decent future for your employees, because one of the key tenets of EOT, employee ownership, is that you get far more control over what the future looks like for the employees of your business as compared to perhaps a trade sale where you're handing over your business to perhaps a large international group and really you lose control of what happens to employee base. So an EOT transaction allows you to give them more control, more say into what happens in the business, and allows you to dictate to some degree what their future looks like. Okay, now with that in mind, Dan's going to spend a bit of time now drilling more into the practical considerations of what an EOT transaction looks like and the process looks like for you. Dan.
Yeah, sure. So obviously now that John's laid out some of the building blocks, really it's my job to unpack some of the practical considerations about what an exit to an EOT really means. So to start with, where does the money come from? ultimately, as John was saying, the deal is financed from the free cash that the business or that the trading entity is going to generate over the next several years. Okay, so from the seller's perspective, normally this means that on day one of becoming an EOT, they can extract any excess cash that sits within the business tax-free. Okay, and then again, practically speaking, the remainder of the consideration for the deal is paid out in regular monthly or quarterly payments over the next 4 or 5 years, as John was sort of saying there a minute ago. Okay, from a valuation perspective, which is obviously quite important, particularly when comparing the EOT route to a trade sale. There's a lot of rules here from HMRC's perspective to make sure that we're not trying to overuse this to our advantage. So really, the sellers and the representatives of the employees have an independent valuation done on the business. Okay, so that independent valuation is ultimately going to be set at the same level or as close to a level as possible of what market rate means. So what the market value would be if you were selling your business to a willing buyer in the open market. Okay, and often when we're involved in doing valuations and feasibility testing as to whether an EOT is right for you or not, often we're doing some forecasting and modeling to demonstrate that the business can afford to pay out the full consideration that we set as our valuation in a period of 4, 5, 6 years around that time. So we'd often do a lot of testing around making sure the business can fund that, testing certain scenarios. What happens if a customer drops away? What happens if the business accelerates in growth? Which again can mean that we often see the payout timeline shorten to 2 or 3 years if the business is on a really steep growth trajectory.
Just want to jump in there because just to make sure that's a really important point, and where over this last 10 years where EOTs have been tested and lots of people have been through different sort of EOT transactions, often where individual EOTs may have failed or companies may have been found wanting, where the valuation effectively has been done incorrectly. And this forecast the future and retesting what the future cash flows the company can actually afford has been misrepresented or badly forecast or not even forecasted at all. So it's really important that there's a process that goes in that looks and helps, we'll work with you to forecast the future so that it's not overvalued, that the business doesn't overstretch itself when paying out the cash to you via the EOT for the business.
And another point to pick up there, I think, as John was alluding to a minute or two ago, with the increase in popularity of EOTs in the last few years, we've seen a few banks and other lenders view EOTs now as a transaction that they're willing to fund, and ultimately that just shifts the balance of upfront consideration versus deferred consideration. So ultimately, these lenders will provide a loan to the trading business, which will again increase your upfront consideration, but the business will then pay off that loan again from its cash flows over time. So that just sort of often or can change the balance between initial consideration and deferred consideration. I think then the last sort of key core point to unpack here really is practically how these transactions are executed and what that means from the seller's perspective. As Alistair, I'm sure we'll come on to unpack a bit more in a minute. One of the crucial points here is that if you're comparing an EOT route to a trade sale, a trade sale route often takes 12 months really from start to finish to see an exit. And during those 12 months, the buyer is in the driving seat. They decide how much due diligence they want to do. They control the timeline of an exit. And when we contrast that to an EOT, what we're looking at really is a timeline fundamentally that's in the full control of the sellers. So the seller has control of when they exit and again their succession plan, if you like. And ultimately, from a practical point of executing the transaction, we can see it executed as little as 12 weeks, really. And again, the seller being in control of that process is a really key point when you contrast it to the trade sale routes. Okay. jumping in here then just to unpack what selling to an EOT means from the business's perspective rather than the seller's perspective. So fundamentally, the trust that John was talking about earlier now becomes the owner of the trading business. Okay, and that trust basically holds the shares of the company for the long-term benefit of all of the employees in the business. Okay, now there are quite a lot of misconceptions about what that means in reality, both in terms of for the employees and how the business is managed. So the employees are not direct owners of the business. They do not hold shares directly, and they do not directly have a vote over day-to-day decisions. Okay, like I said, that trust holds it for the benefit of all employees and acts in the interest of everybody as a collective. But day-to-day management of the business day one in EOT is often not very different at all to how it's been managed to date. The day-to-day decision making still sits with the management team, still sits with the same people often that it has done. And again, when we think of EOT as this vehicle for succession planning and this tool that should be used to help owner-managed businesses exit from their business, really, the view here is that we're building a succession plan around the transaction, and that we nurture a leadership team to replace the seller's role in the business over time, so that the shareholders who may have, been themselves in full control of all day-to-day decision making, they ultimately want to build the right leadership team in the business to succeed them. Okay, but the one sort of key core change that is a new thing for the business post transitioning to an EOT is this new layer of governance. That the business is now owned and should be run for the benefit of the employees, and to make sure that it is being run in the best interest of the employees, we have this new trustee board that essentially supervises management to make sure that they're acting in the right interests. Like I said, they don't have a say normally in day-to-day decision making, but they do have some powers to make sure that the business is being run at a macro level, consistent with its new owners. Okay, and just to touch on very briefly, that trustee board is typically at least 3 people, and those 3 people are: 1, the seller, as long as they're still owed money from the transaction, they would normally form a part of that trustee board. 2, there's an employee representative who again represents the voice of all employees in the business. And thirdly, we typically have an external or independent trustee who comes in and gives some perspective and helps deal with again the business's governance going forward. Okay. I think Alistair's now going to pick up with some of the bits I was touching on around comparing an EOT exit to trade sales or traditional management buyouts.
Yep, thanks, Dan. So an EOT may not necessarily be appropriate for every business, we should point out. The other exit routes available are a management buyout, a trade sale, and a private equity sale, although the latter two are kind of one and the same, essentially. So in this section, we're going to briefly compare these, and we'll see how powerful a solution an EOT can be. We're certainly not trying to deter anyone from either an MBO or a trade sale. The former especially can offer some of the same succession planning advantages as an EOT, and it'll certainly in some cases be more appropriate. In the course of our work with any business, we'd certainly explore all these options, whether there's a plan to exit imminently or as part of a longer term right to left planning. This being a webinar on EOTs, though, that will be the focus of these comparisons. So firstly, we're looking at timelines, and we're comparing an EOT and a trade sale, noting that an MBO would sort of fit roughly into the middle of both of these timelines. The key distinction between the timeline for an EOT and a trade sale is the control the vendor has over an EOT timeline. Preparation for a trade sale can take well over 6 months. We've got to build out financial models. We've got to prepare all documentation requested by the buyer. We've got to conduct a lot of market research and identify potential buyers before we even start marketing. All of this can cost advisor fees too, with no certainty of any success. For an EOT, though, from the point of conducting that initial feasibility study, whereby we determine whether an EOT may indeed be appropriate for a particular business, a sale to an EOT could actually be completed in as little as 10 weeks, whereas the overall process for a trade sale, allowing for the aforementioned 6-month preparation period, plus an actual sale process is probably going to be roughly the same length, could be more like 12 months or even longer. And the key factors yielding such disparity are the initial marketing process required for a trade sale. That's not needed inherently for an EOT sale, which is inward looking, and the significantly longer due diligence in drafting of transaction documents that's required for a trade sale. The buyer, being a third party in that case, wanting various warranties, wanting to, uncover more stones and look deeper into the business before proceeding. Now, during that longer period of time, a vendor in an EOT transaction would have received their initial cash consideration, and they'd be working on a phased exit and the generation of future profits within the business to fund their remaining consideration. So they'll be quite ahead of the game at that point. When we align the two timelines overall, the lengthier overall sale process for a trade sale is normally offset by a shorter period of time to receive full consideration. That's what we're referring to as the earn-out period here. So both exit routes overall, may typically yield ongoing owner involvement in the business for sort of 3 to 5 years, and that's probably going to be longer for an EOT. So an EOT is certainly a steadier and more long-term process, we should point out.
Just to highlight a key point there as well, just to add what Alice is saying, is within a trade sale, the thing that's really working against you is uncertainty, right? So, and Alistair will point out, we're going to point this out again later, it's certainty versus uncertainty, and that in a trade sale timeline, we've worked on trade sales where they've closed in 3 to 4 months. There were some, very motivated buyers and sellers, a very straightforward transaction. That's certainly possible. And getting all their money out in one go, that's certainly possible. But also the opposite is very possible, where a trade sale fails, a trade sale takes 2 years, 3 years to close, with then very long payout periods. There's such a wide variance in possible outcomes of a trade sale, where within the EOT environment, you're in control. It's seller control. You set your timeline, you agree a timeline with your advisors, and there's very little that can actually happen to upset that timeline. There's very little external factors that will happen to overrun by any significant amount. Okay, so the EOT gives you certainty of timeline and quite often a shorter timeline.
Cool. Thanks, John. So a quick comparison now of net outcomes, or what we mean here is net proceeds from a seller's perspective arising from an EOT versus an equivalent trade sale or MBO type transaction. So given the recently announced rises in CGT rates, which I'm sure we're all aware of, if we assume a sale that's happening post 5th of April 2025, and we assume that a vendor's full, formerly entrepreneurs relief, now business asset disposal relief entitlement is available, we can actually see how much higher a price is required for a trade sale or an MBO to achieve the same net outcome at each level of consideration taken out in an EOT transaction. And we can see, of course, as the value goes up, the gap widens, such that a trade sale price in excess of 3 million higher would be needed to generate the same net outcome as a 10 million EOT exit, and obviously that gap widens and widens the further up the value chain we go. So pretty useful illustration there of the tax outcome from an EOT sale.
Because quite often, when we start conversations around EOTs, there is this misconception. It's not always a misconception, because sometimes it is based in truth, but I'm going to achieve such a bigger value on trade sale than I am on my EOT, so I must pursue a trade sale route, because I can't give up all this value by going the EOT route. And when you crunch the numbers and you work out, well, particularly now in the current tax environment we're looking at, that my trade sales not only got to be around 20 to 23% more just to be the same, it's got to be 30, maybe 30%, nearly 40% more to even the risk to line up. So a risk adjusted value is the same. So you've got to have a view that if you're going to take that view, I'm going to get much more at my trade sale. It's got to be much, much more versus your EOT, okay, which is not necessarily a likely outcome.
Now, aside from tax, although we have still got it on the seller line here, let's just have a look at the other benefits for sellers, employees, and the company itself that arise from an EOT transaction. So for the seller, having spent years of blood, sweat, and tears building up the business, they can walk away knowing their legacy is pretty secure and that all employees' jobs ought to be fairly safe, and things really just continue more or less as normal. The seller can exert a far greater degree of control over the transaction itself. They can retain significant influence while their consideration remains unpaid as well. They also don't need to jump through such a myriad of hoops arising from buyer due diligence. And on top of the 0% CGT, there's reduced risk of price adjustments or any warranties written into deal documentation that might come back to bite them later on. Now for the employees, headline advantage is tax-free bonuses of up to 3.6k. They're available annually via the EOT. Employees will or ought to also feel empowered through having a voice in how the business operates. Over time, they may also enjoy shareholder-esque benefits in the event of or in the form of income distributions, and or if the company is sold. Employee-owned companies also just can foster a real culture of engagement overall. They have a family type feel, even in much larger businesses, and that arises from everyone being or feeling united in pursuit of a common cause rather than simply turning up for work and doing the 9 to 5. And for the company, the long-term future is pretty secure following an EOT sale. No sudden changes are likely to arise from the pursuit of a future sale, as is probably going to be the case, or may be the case, with a trade sale, a private equity sale, or a management buyout. The business is therefore going to be left to grow sustainably with a more longer term outlook and minimal disruption arising as a result of the vendor and pretty much all of the incumbent senior staff remaining in place. And the company itself, of course, it benefits from the enhanced motivation of all of its staff. Now, I just want to round things off with an overview of the key characteristics of an EOT versus an MBO or a trade sale. John has touched on the kind of the arguments that can go both ways really as to whether an EOT or an MBO or trade sale can yield higher valuations. Putting that aside, it's important to remember though that beyond that kind of valuation theory, an MBO or trade sale process is inherently going to have some or more negotiation scope. However, payment-wise, an MBO or a trade sale typically means more cash up front for the seller, although that can be to the detriment of the business if the company ends up being loaded with debt to fund that. Timing-wise, as we said before, an EOT is vendor-led, as is really an MBO, as it's inherently inward-looking. A trade sale, however, for the reasons we've already been over, is going to yield a much longer process. Looking at succession itself, as we've been saying, one of the key advantages of an EOT is the seamless succession and enablement of the kind of continued sustainable growth of an EOT-owned business. As a result, there's likely to be more of an emphasis on long-term goals and legacy. An MBO, though, being acquired by management, certainly affords a smoother succession plan than a trade sale, but legacy-wise, whether that buyer ultimately is a management-owned vehicle or a complete third party, that buyer, as we said before, is likelier to be exit-driven. So all business planning undertaken is really, with that aim in mind. So naturally, there's probably going to be more disruption. And finally, we should just touch on the risk of unpaid consideration. It's certainly lower with an MBO and a trade sale. It's not determined to a great degree based on future company performance, so probably just worth pointing that out. I think we'll just finish off with some FAQs before we move over to any questions. So, Dan, do you want to kick this off?
Yeah, sure, happy to. So I think maybe just to recap some of the first things that we talked about a bit earlier. So who is this really appropriate for, and what sort of size business suits an EOT? I think really fundamentally what we're looking at here is it's more about the number of employees that you have rather than pure valuation. So we're talking about businesses that have really five or more employees that aren't either shareholders or family related. In terms of exit value, we see EOTs of between a couple of 100,000 and tens of millions really. So number one is certainly more about the employees that you have and who the trust is going to benefit going forward. I think picking up on number two, as I outlined a minute ago, really the key thing here, just to debunk in terms of common myths about EOT, is that management wise of the business, leadership doesn't typically change going forward all that much immediately post EOT. The exiting shareholders or exiting founders typically, as Alistair alluded to, exert a good amount of control whilst the business is still owes them consideration or owes them money. So that they have veto rights over certain decisions that the business could look to go into, either taking on debt, hiring employees above a certain salary, things like that. But yeah, the kind of key thing there that we talked about earlier is that new governance around a trustee board who would look to supervise or make sure the business is acting or the trust is acting in the best interests of all of the employees. Cool. Did you want to pick up number three, Alistair?
Sure. So in terms of who would be a trustee, typically you'd expect at least 3 trustees, sometimes or often more. And thinking about who those 3 might be, we'd expect that to be or that to comprise the seller, an employee representative, and often an independent trustee, just to ensure good governance and ensure that sensible checks and balances are in place. Typically, the seller would remain a trustee until at least their consideration is paid out. And when we're talking about trustees, in reality, what typically happens is there's actually a single trustee company that's set up, and the directors of that company are the de facto trustees, so often referred to as the trustee directors. But we'd expect at least 3 involving, comprising those individuals, sometimes more.
It's worth pointing out as well, actually, early on in conversations with clients when we're exploring this route, the question of who's going to be a trustee, who's going to be directors on my new board directors that constitute. This is often one of the first hurdles we've got to get through, particularly for the smaller end of EOT transactions, where it's not uncommon for the company to effectively be led by 1 or 2 people, and suddenly we're having to ask questions of who's the second, third, or fourth person that's going to be involved in here. So if you're thinking about this as a route, one of the early things to sort of start going through your head is, who would be alongside you on the board or on the trustees to make this work.
So looking at number 4, the answer to number 4 is yes. So to motivate key staff and management, new shares may be allotted by the company to those staff. More often is the case, something like EMI options or any sort of share options might be granted to those individuals separately from the EOT in respect of shares in the company in order to incentivize and retain them, and there may be appropriate kind of hurdles or incentives or targets put in place for those individuals to realize those shares or the value of that equity. But yes, certainly that's something that we see quite often.
And just a bit more colour to that as well, because you remember that one of the key rules and tenets of EOT is, in its basic form, the employees are beneficiaries of the EOT, and those employees as beneficiaries are all treated equal or more or less equal. Okay, but in most businesses of a certain size upwards, there's a certain set, normally the leadership team, that are really driving the value of the business. You want to treat more equal than the others, right? So it's not uncommon for, a lot of businesses have share option schemes, as just saying, for your leadership and not for your main employee group, because there's a certain group that you want to win really big if they drive growth, if they drive economics in the business. Okay, and as advisors have learned to use the EOT structures more carefully, more creatively, it's certainly now a well-trodden route to have, and the key point here, you can have an option scheme within an EOT. Okay, not everyone does it this way, and for the medium larger onwards where this is most useful, but you can do that. That's the key message.
And finally, can a company be sold out of an EOT? So yes, whilst an EOT itself can't be sold, conceptually it just doesn't work. The trustees of the EOT may decide ultimately to sell the shares in the company. Practically, this is probably going to be a tough decision because that would need to be deemed to be in the benefit of all employees. So there's naturally going to be, a lot of decision making, a lot of factors that feed into that decision. And on a case-by-case basis, sometimes such a sale might be for the benefit of all employees, sometimes it might not be. So that would have to be weighed up as part of the trustee's duties. But in the event that does happen, a tax charge arises depending on the timing after the sales of the EOT happens. A tax charge would likely arise on the part of the trustees. That would be funded by the company itself, and then any remaining proceeds are free to be distributed among the employees as per the terms of the trust, and those would be taxed as employment income on those employees.
Right.
Nice and simple.
Nice and simple. All right, excellent. Well, we're up at 46 minutes, so we'll bring this wrap this up now as well. We haven't got any Q&A, which is what we expected. It's quite a technical topic, but hopefully what we've done today is at least answer some high-level questions, outline basically and given basic what an EOT is, and given you some of the terminology and tools to start thinking through, is this something that you and your business could explore, and is it useful as part of your succession planning? We're becoming bigger and bigger fans of using EOTs when we're working with clients on the succession planning. We lead in MBOs and trade sales, all the same, but more and more certainly in the client base that we work in. So we're very much SME advisors working from startup to maybe 30 to 40 million turnover, right? In that space, EOTs quite often are actually a really neat way to create exit. And probably for me, the most common sort of reason why EOT seems to be a good route is actually not really the tax benefits that come with it, but the style of transaction. Right? A trade sale in particular is a really tough transaction. Right? It is not uncommon for most people to end up not very friendly with each other by the end of that transaction, certainly as the transaction is completed and there's deferred consideration to pay out, etc. Okay, trade transactions are quite hard on the leadership of a business. Compare that to an EOT. An EOT is quite delicate. An EOT, you're in control. There's not, a myriad of many advisors around you all negotiating and asking for time, right? There's not a deep level of due diligence on your business, opening every closet to see where the skeletons are. You're in control. And actually in the space that we work in, commonly that ends up to be the better style transaction that suits that business. Okay. All right. We do actually have one participant wanting to ask a question. Jessica, are we able to bring them in? Or Kira there? Kira, would you like to see if we can unmute you and you can ask a question? Or you can post it on the Q&A tab, which is technologically easier. Let's see if I can bring on screen. Kira, do you want to unmute and ask a question?
Oh, yes. Hello. Can you hear me?
Hello. Yes, we've got you loud and clear. And hopefully we can answer your question.
Lovely. Well, it's probably fairly simple, but just basic stuff at the beginning of the process. Mm-hmm. Who would you approach to value the company? who would do the feasibility study for all of that?
Mhm.
And given the long timeline over which this all happens, how do you manage the changing or the potentially changing value of the company if you're still growing? Because what might be the valuation at the beginning of the period, when you may very well not be the valuation of the company at the end of the period, and yet you're still in it and working, and
Mhm.
so how do you navigate all that?
With due care, with very due care. So it's actually not an uncommon problem, and Dan will be smiling as we're facing that problem commonly with clients, right? If you are a growth business, but also the opposite applies as well. If you're in a business where
Yes.
actually you might lose a major client during that process, and suddenly that has a material impact on your valuation output. So valuation is a difficult thing. So just let's get to the more difficult question. So first of all, who does your valuation? So normally a competent outfit such as your accounting firm or lead advisor. So when we work with clients, we come in, we do the lead advisory. So the all the studies at the beginning, the feasibility studies, trying to map out and structure what a transaction looks like. And because we've got the capabilities in house, we'll do the valuation as well. And the valuation, we find our approach to it is actually deeply part of the feasibility study. Okay, because a lot of our valuation methodology when it comes to EOT is based on future forecast, not so much the same as a traditional valuation process, which you're commonly just looking at comparative transactions, looking at multiples applied to profit, okay, which you'll still use as part of this, but the future forecast and reforecasting what does the world look like post EOT is really important to coming up with the correct value really for what will support a very successful transaction. Now, you might have a 6-month period from starting your feasibility study to executing, and you might do your valuation really early on as part of that. So you've got this long period, like you're stating, that things could change, right? Now, the good thing about EOT is that you're in control during the whole transaction. You haven't entered into a heads of terms with an external buyer who said, right, this is the value of the business today. And so when things move on and value has to change, people get awkward, But that being said, in pretty much most of the trade deals we'd be part of, is value changes during that process as well. The heads of terms get negotiated, a key client loses, what have you, and people come back to the table and negotiate. But at least with an EOT, you've got your valuation model set up, you've agreed your principles of valuation for your business, and if the forecast of the business starts to do that more, or indeed start to do that more, you can adjust much closer to the time about, is this now the appropriate valuation? Do we need to adjust up and down, or indeed do we need to delay the transaction to resolve some of these uncertainties before we enter? Okay. But I think the key message here is that you're in control of that valuation and you can adapt it throughout that whole planning process.
Okay. And during the time of your exit, if it's let's say it takes 5 years.
Yeah.
Let's say it takes 5 years. Could you I guess you decide what you want, but you could envisage to at least scale down, for example, instead of working 5 days a week, you could go to 3 days a week, or that sort of thing. So and I guess you would just adjust because you'd still be taking, I presume, your normal payment as well as the sale consideration.
Absolutely. So you've kind of someone who's exited via EOT normally has then 2 payments that come to them. They're deferred consideration paid monthly, quarterly, annually, whatever is agreed as part of the deal. Plus, now what normally happens actually is that you agree normally with your board, which is supported by your trustees, a market rate of salary for you to work in the business for as long as you're working in the business. Which, if you're saying, which is common to most people in their planning, is I'm going to work day one of post EOT, I'm still working 5 days a week, maybe 7 days a week for most entrepreneurs. But actually my goal is to work 2 days a week within 1 year. And you might scale down your salary part during that process, and but you'll still be receiving your deferred consideration for the sale.
Right, got it. Okay. And that's the other thing, of course, you have to create a limited company before you go into any of this.
100%. Yes. So this
Yes,
is
right.
a structure for limited company owners to exit to a trust. So you're selling shares in this case. So you
Right.
need to incorporate and sell. And I think the important thing is if you're a small company, are some of the tests around control and looking at, do you actually have enough employees in the business that don't control any shares, or part of the family that controls the shares for the EOT to work. Okay, so some testing would need to happen to make that make sure it works for you.
Yeah. Okay. All right. Good.
Cool. All right.
Did I have any other questions? Probably a bazillion, but those are the ones that sprang to mind straight away.
So like with anyone else on this call, very much we'd love to talk to you more on one-to-one basis and deal with lots of specific stuff. So Kira, you can reach out to us. In fact, Jessica will reach out to you to see if it's worthwhile us organising some one-to-one time,
Okay.
so we can jump into it, because these are any exit process. We're giving you the high level tools here and thinking about, is this something that could work for you? But there are no two transactions the same. Everyone's circumstances
yeah.
are very, very different. So really helping navigate that with you is a very personal process.
Absolutely, because every company is different, of course. Yeah.
100%.
Okay.
Yeah. All right. We've got Adrian with his hand up as well. So Adrian, we'll bring you on, and let's see if we can unmute. Do you want to unmute Adrian and ask away?
Yeah.
There we go.
Can you hear
me? We've got
Right.
you. Yeah.
Very quickly then. So picture the scene. It's gone through a year down the line, and somebody leaves for whatever reason, or removed from the business. What I take it, they lose all ownership of their share, I guess. Is that right? And also, secondly, what if people join 3 or 4 years down the line into that organisation?
So when you talk about leaving and joining, are you talking about people who will have shareholding or just employees?
I was thinking employees, to be fair, but also I guess there is a shareholding.
Okay, right. Let's maybe deal with both. So employees, as they join and leave, enter the class that are the beneficiary and exit the class that beneficiary. And the classification of who is an employee of the business can involve past employees as well. But you can adjust that to how it works best for what you want to happen in the trust. But if you think more basically, once someone's exited the business, more or less they exit from being a beneficiary of the business in most cases. And actually, when someone joins as well, there's quite often a delay of a year put in between them getting access to being a beneficiary, just in case they might leave in that probation period before they get access to it.
But a good
so it's quite flexible. Yeah.
Okay,
yeah.
Got it. Thank you.
And it's worth actually just on that point as well. An employee, they don't really necessarily have to even, technically you'd hope they'd be aware, but they wouldn't even need to be aware that they were a beneficiary in this case, because they are a net recipient of something and they're not signing up to legally expose themselves from a risk perspective or have to participate in anything. An employee just forms a class of beneficiary. So they don't have to sign something saying, I agree to be a beneficiary. Okay. This is actually a common question that we get.
But they do get that 3,600, I believe, is it tax-free each year? So they've got to be aware of that, I guess.
Well, so it's not an automatic that the EOT ultimately pays it out. It's a tool that the directors of the business can use to confer benefits onto the employees. Okay. And actually, one common thing we see in EOT structuring is that the exiting shareholder might stipulate that until they're paid out all of their money, people shouldn't be receiving these tax-free bonuses, or at the very least, the exiting shareholder gets a veto over the payment of any tax-free bonuses to people before they're paid out. Okay. And there's different variants on that. Everyone wants something slightly different.
Right. Got it. Thank you.
Okay. Excellent. All right. Well, I think we'll wrap things up there. I think, like I mentioned before, is we're open to having conversations with everyone on a one-to-one basis. We work in this sector as lead advisors, tax advisors, and corporate finance advisors. So we typically engage with clients to pick up the full run of work from I'm thinking of exiting my business through to executing on that. And we work with a set of lawyers to do all the legal work through the process as well. But yeah, we'd love to talk to you about your ideas and plans and be more helpful and as helpful as we can be. Cool. All right, well, have a fantastic week. Enjoy the rest of your Monday. We'll see you all soon.